and welcome to today's webinar, which we're delighted to be running in association with Netwealth. My name's Jo Morvan, I'm the Editor-in-Chief of ACCA's Accounting and Business magazine. Today we're going to look at the key differences between buy-to-let property and pensions that can impact your retirement plans. Tom Kimchi is a client advisor at Netwealth with over 10 years' experience advising high net worth private clients. And Louisa Gaynor is Associate Client Advisor at Netwealth, a chartered tax advisor specialised in providing clients with UK tax advice. Before we get started, I just need to run through a few housekeeping issues. So the presentation is accompanied by slides that will automatically change as our speaker presents. If you find they're not progressing, you might want to refresh your browser. For PC users, that's F5, and for Mac users, Command and R. We'd be delighted if you sent us in some questions, and you can do that at any time using the question area on your screens. And we'll go through those in a Q&A at the end of the presentation. The whole webinar will last about an hour. You can enlarge the slide area of your screen by grabbing and dragging the bottom right-hand corner of the slide area window, and you can download the presentation slides as a PDF by clicking the resources button at the bottom of the screen. There's also a help button if you have problems with the technology. So that's it for the introduction. I'm going to hand over to our first speaker. Tom, over to you.
Thank you very much, and good afternoon, everyone. Moving on to the first slide. As said, I'm Tom Kimchi and I'm a client advisor at Netwealth, and I'm joined today by Louisa Gaynor. Today we're going to be talking about properties and pensions, and then specifically how to generate an income in later life. So some of the things we're going to look at today include the difference, first of all, between property and investment assets, those investment assets being the ones you might hold within a pension. We're going to look at the macroeconomic environment and the UK property market. We're going to look at changes in legislation, both relating to pensions and properties. We're going to look at the right mix of assets for different stages of retirement. And then we're going to look at Netwealth's approach, finally, to both financial planning and investing. And I thought I would get us started today. Sorry, I should actually say, as it says at the bottom there, we have a Q&A available on the screen. But also, if there was anything more specific, please get in touch at advice@netwealth.com via email. But I thought I'd get us started today by looking at a report that covered 100 years of data from Oxbridge Endowments. And it actually suggested that property in aggregate over long periods of time is lower risk than equities. But once you factor in volatility that sometimes people don't think about and expenses, it's not always the easy win that it first appears. And we're going to look at some slides later that show why it might appear to be an easy win. But I thought this was quite interesting, and there was one quote in particular from John Maynard Keynes back in 1938, which I'll just read out now, which I thought was quite an interesting one. And he says, "One must not allow one's attitude to securities which have a daily market quotation to be disturbed by this fact or lose one's sense of proportion. Some bursars," and he was a bursar at King's College in Cambridge, "will buy without tremor unquoted and unmarketable investments in real estate, which if they had a selling quotation for immediate cash available at each audit would turn their hair grey. The fact that you do not know how much its ready money quotation fluctuates does not, as is commonly supposed, make an investment a safe one." The summary there really being that property doesn't have a day-by-day valuation. Most people tend to hold it for the long term, which is great. But if you did have a day-by-day valuation, particularly during very volatile times or lots of uncertainty or periods where there's not much liquidity in the market, then it actually would probably surprise quite a lot of people how much the actual day-by-day value would fluctuate if you did need to sell it imminently. So just an interesting starting point there. I'm now going to hand over to Louisa, who's going to talk about asset mixes.
Thanks, Tom. So in order just to help frame this property versus pension question, I think it's just quite important to start by thinking about your overall asset base and how it's currently split. And we find a really useful way of understanding this is to look at this in the context of something that we call the three-pot theory. And this should just help you think about how your assets are allocated across these three hypothetical pots. Because when you move into a phase of your life when you're planning on reducing the level of your income by retiring, for example, and so look to your other assets for support, understanding liquidity and thinking about how you're allocated between these three hypothetical pots is quite important. So here on this chart, what you can see is we have pot 1 at the top, which is our cash pot. So that's really our very short-term and liquid pot. So this is typically going to be cash in an instant access bank account. It may be the income we receive from employment or rental income, things like that. And it's going to have outgoings as well to cover the cost of living on a daily basis. And then as we just drop down at the other end of the spectrum, we have pot 3 at the bottom. And this is for our much longer term investments that will typically be quite illiquid. They may be quite high cost and quite volatile, but often in the longer run, we would expect or hope that they would generate the most return. And this most commonly includes our property, and perhaps really in the context of this session, a buy-to-let portfolio as well. So it could also take the shape, but it could also take the shape of something less common, like a private equity investment or an investment in a friend's company. And now just looking at pot 2, and this is where the pension pot should fall, and is really where what we focus on here at Netwealth. And it's really what the core of what a high quality investment or wealth manager should provide. So pot 2 is for the medium to long term and should be designed to provide that stable core of diversified equities and bonds to your investment, with the aim of just beating inflation through time. And so really the key for this slide here is just understanding the relative mix between pot 1, pot 2 and pot 3, and thinking about how you're currently allocated between these different pots and making sure that you're being as efficient as possible. And perhaps this next slide here is just going to add a bit more context to this. So this chart here is purely an illustration and just looks at how we split between the 3 pots between the different stages of our lives. So on the x-axis, you can see the different decades through one's life. And on the y-axis, you can see an example of how your asset allocation may change through time between those different pots. So as a reminder, we got pot 1, which is the cash pot, pot 2, which is providing you with that diverse and stable core to your investments, and pot 3, which is that illiquid pot. So that's where your property is going to be. And what we can see here is that generally, for most of us, more early on in our 20s when we're younger, you might be building up that cash pot or have been gifted some cash to help you buy that property, but you don't own one yet. And that's the grey part of that bar there. And then when you buy the property, that's going to probably form a large majority of your wealth at that stage. But then, hopefully, over time, as you grow through your career and build up some further earnings, saving into your pensions and your ISAs, you can see things changing. And finally, as you get into your retirement, you're going to start changing that mix around again. And that's when we usually suggest that maybe it would be sensible to consider holding a larger cash sum as well, between 12 and 24 months. And that's really because there may be that period where you're drawing down on your investment assets or more reliant on that rental income from your buy-to-let property, and you're no longer just relying on that employment income. So you're no longer just building up savings and you're starting to draw down on them. And so this cash buffer can act as a good support during times of market stress on the investment assets or void rental periods. So clearly what we can see from this chart is that there are a lot of different circumstances. And today we're going to be focusing on really that mix between pot 2 and pot 3. But beyond this, if you want to have a conversation around your own specific circumstances, please do get in touch, as our team are always available to speak with you about this. So I'm just going to hand back now to Tom to provide a quick update on the current economic environment and UK property market.
Thank you, Louisa. Going to start by looking at central bank balance sheets over recent years and particularly over the last year or so. So you can see on this chart, it's the Federal Reserve in America, the Bank of Japan, and the ECB, the European Central Bank. And you can see coming into 2009, at the start of this chart, the balance sheets were expanded anyway compared to where they were a few years before that. But in the last year or so particularly, they've really expanded. So you can see, looking at, say, the Federal Reserve in America, it started off in 2009 around 2 trillion, did increase over the next decade or so. But in the last year or so, it's really sharply increased, and now it's sitting at close to 8 trillion. So a really large increase there, and largely due to central banks wanting to maintain financial stability, not being too worried about inflation. That's meant lots of easy monies in the economy, and of course property prices have continued to increase significantly over that period. I touched on inflation there. This goes back to 1989. We can see inflation rates in the UK, this is UK CPI, have generally stayed low and positive. Now, I don't have the latest inflation figures on there, but of course inflation is substantially higher now, but still not quite as high as we saw at the start of this chart back in the early 90s. And there's lots of debate as to whether recent increases in inflation are going to be permanently, whether they're going to be permanent, whether they're going to be transitory. It seems sort of every day in the news now there's something that suggests it's going to stick around for a little bit longer and a little bit longer. Energy prices being a good example right now. But generally speaking, inflation has been low, but it has been positive. So you do get some rare examples of inflation dipping below zero. So during the financial crisis was a good example, but generally speaking, it is likely to stay positive. One interesting thing to consider is the link between CPI and house price inflation, which tends to have an interesting relationship. Sometimes they can go hand in hand, so house prices go up at the same time as inflation, but that hasn't happened so much recently. Inflation's been low, but house price growth has been much higher. Moving on to that specifically now, we can see here UK house prices and the growth rates of that, going back all the way to 1952. So the left-hand axis, that is the average price of a house in the UK. You can see that's increased quite substantially, and I wouldn't say steadily, but it's mostly on an upward trajectory. There was a dip sort of during the financial crisis, and again coming into the 90s, I should say. But generally speaking, there's been lots of increases in house prices. Of course, that makes people very positive on property in general, as most people have lived through that and seen it firsthand. Lots of people in the UK, of course, own homes to some extent. And you can see the blue part of this chart shows the annual change. And again, a little bit like inflation, but more volatile. So we do see more negative periods, but generally pretty positive. That does lead into questions about how sustainable this is. And we can see that in a couple of slides. But first, I just wanted to look at interest rates, which really have caused this house price growth. So you can see here the Bank of England base rates. You can see going back to 1975 here, it was much higher in this period. So the late 70s, the 80s, and relative to now, even the 90s and the early 2000s were periods of relatively high interest rates, certainly proportionally to what we've seen over the last decade or so. But interest rates being so low means mortgages are much more affordable, and it's much easier to generate the sums you need to buy a property and to pump money into the property market. So interest rates are still currently very low, but this ties back into inflation. So if inflation was to increase significantly, the Bank of England would be tempted to, of course, increase interest rates. That's unlikely to be very positive for property values in general. And we can see here how that works specifically. So we can see, again, going back to, say, the early 2000s, that sort of time, the Bank of England base rate tracked mortgage rates quite considerably. But as it says there, falling mortgage rates have really helped to cushion the market from increasing affordability criteria, because going back to, say, 2008, the financial crisis, of course, lots of people weren't able to repay their mortgages because they were given arguably on too favourable terms. But since then, although mortgages have become harder to come by for certain people, so before you could sometimes get a 100% mortgage, you wouldn't even need to give a deposit, or you could self-certify your earnings. That's gone away, but because now interest rates are so much lower, mortgages are still affordable and people are still able to generally borrow a lot of money. But we can also see a bit of a disconnect between the base rate and the variable rates there, developing sort of since 2009 sort of time. And then lastly, I just wanted to look at really a key metric here, which is the ratio of house prices to earnings, because of course house prices can go up, but people need their earnings to go up to match that, to be able to afford these mortgages, particularly in an era of stricter mortgage affordability requirements. So we can see quite a stark increase here coming from, say, 1997 to 2007. We see back in 1997, the average house price was only 3.5 times the average income. That's now over double that rate, and it's fluctuated a little bit. It peaked just before the financial crisis, came down a little bit, but it's now come up again to nearly 8 times average earnings, the average house price. So if interest rates stay very low, or if they were to get even lower, if there were to be negative interest rates, this trend could continue, but it does seem for now to have reached somewhat of a high point, and something to bear in mind when thinking about what's going to happen in the future. So I'm just going to pass over now to Louisa, who's going to look at some of the differences between property and pension when choosing where to invest.
Great, thanks, Tom. So now that we've had a bit of context into the current economic environment and UK property market, I thought it would be worthwhile just to run through some of the key differentiators and recent changes in the legislation that have really impacted the debate around properties and pensions and funding your retirement. And something we get asked a lot is what is the benefits of investing in pensions versus investing in property? And so I've really just listed a summary of them out here just to highlight the key differences and some of the pros and cons of investing in the two different asset classes. So starting at the top, with pensions, one of the best advantages you can get is that tax relief on the contributions on the way in. And this is something you wouldn't get in the purchase of a buy-to-let property, and it's something that clearly increases the value of your pension pot and your savings towards retirement. So with pensions, you get that tax relief at your marginal rate of income tax. So if you're a high rate taxpayer, you'll get tax relief of 40%, and an additional rate taxpayer will get tax relief of 45%. So, of course, you do pay tax when you draw from your pension, but you may be able to use this to your advantage if you're thoughtful about it, in that when you put money into your pension and you're a high rate taxpayer, you could be paying tax at 40%. And then if you structure your withdrawals carefully, you could then look at when you're drawing an income from your pension being a basic rate taxpayer, and so only paying tax at that lower rate of 20%. So you would have benefited from that 20% difference in income tax, and also from the tax-free growth within the pension fund, which I'll come on to in a moment. Just dropping down to the next row of the table now, with buy-to-let properties, you have the ability to use leverage, which can essentially enhance your returns. If, for example, you buy a house worth 200,000, but you only put in 25,000 of your own cash, you're going to be benefiting from the growth on the full amount, even though you've only put in that 25k of capital. So the ability to use leverage can really scale returns in the long run. But of course, there are also risks to consider with this. For example, changes to mortgage interest rates and the stability of the property market. And with pensions, you don't have that ability to use leverage. So you can literally just invest what you have. And another key difference here is how much money you're actually able to put in. And this is really based on legislation. So with buy-to-let properties, there's no limit in the number you own. You're only really limited by the amount of capital at your disposal and also how much banks are willing to lend you. With pensions, however, if you exceed your allowances, whether it's the annual allowance or the lifetime allowance, you are limited in the amount you can contribute without incurring a tax charge. So the LTA, the lifetime allowance, which we'll come on to in a little more detail later on, essentially limits the value of that your pension capital can grow to before being subject to a punitive tax charge. It can sometimes still be worth exceeding this limit and paying a tax charge, as your pension is a good estate planning vehicle and it falls outside of your estate for inheritance tax purposes. But generally speaking, it's good to avoid paying this charge if you have efficient ways of mitigating it and if it aligns with your objectives. A lot of people are also limited by the pension annual allowance, which caps the amount you can pay into your pension on an annual basis. So for most people, the gross amount is £40,000 per annum. But if you're a particularly high earner, earning something above 200,000, for example, and there are, of course, nuances around this, your annual allowance may be tapered down to a minimum of £4,000 per annum. And again, I'll come on to this in more detail a little bit later on. But what I'm really trying to show here is that it's actually just important to bear this in mind, particularly if you're a high earner, that you may not be able to put in to your pension as much as you might like. Looking now at the growth and income you receive on a regular basis, you can get some small deduction in the form of a tax credit for the mortgage interest paid on a buy-to-let property. And we'll come on again to that in a little bit more detail. But broadly speaking, you pay income tax on the net rental income received, and also capital gains tax at the higher rates of 18% and 28% for the disposal of any properties. Whereas in a pension, you don't pay any of that. The investment is sheltered from tax and is able to grow free of capital gains and income tax. And these tax-free returns can compound up over time and have a big impact on the value of your overall investment. So looking now just at the restrictions on accessing these assets. With a buy-to-let property, it's really quite simple. You can access these whenever you want, and provided you can find a buyer, you can sell it whenever you want. and you're not limited by the age or anything like that. With a pension, however, you can only access the investments after the age of 55. And it's important to bear this in mind, because if, for example, you're at the age of 30 and you suddenly require the funds, you'd be unable to obtain these from your pension. The government is actually also looking at increasing this age band to 57. So this restriction is something worth noting and being mindful of when making additional contributions. And coming now to that final point, which I touched on earlier, and is probably one of the most important features of a pension, it's the inheritance tax advantage of holding one. It doesn't form part of your estate for inheritance tax purposes. So people who have much more taxable assets that they can live on, they have other investment accounts, for example, they have buy-to-let properties, or just are sitting on a large amount of cash, they may actually want to think about leaving their pension untouched so that it can pass on to their beneficiaries without paying that 40% inheritance tax charge. And there are different rules for the pension in the hands of the beneficiary. For example, if you die before the age of 75, they will be able to take that income from the pension free of tax. And if you die after the age of 75, they will pay income tax at their marginal rates. But it does still provide you with that greater level of flexibility because they're still able to delay drawing upon it. And so they could wait until, for example, they're a lower rate taxpayer and so pay tax at the marginal basic rate tax rate of 20%. Or they could as well just leave it and pass it on to their beneficiaries again. And whilst this is happening, the money inside the pension remains in that tax wrapper, so it's still able to grow free of capital gains tax and income tax. And regardless still of whether your beneficiary pays any income tax on the pension drawn, from an inheritance tax perspective alone, this makes the pension a very attractive alternative to a buy-to-let property, which will form part of your estate for inheritance tax purposes and for which IHT will be due on. So these are just some of the key considerations to think about when you've got some cash and you're thinking about whether to put this towards a buy-to-let property or a pension portfolio. And related to this as well, and of really equal importance, are the risks inherent in the pension versus property debate. And you can see here some of the risks in this table, and these are actually risks that apply to most investments. And so really it's just looking at the relative weight and severity of each of the risks. So starting with liquidity, this can of course apply to property. It falls within that pot 3 of that 3-pot theory analogy we were talking about earlier, and it can be really quite hard to sell at times. The process for doing so can also be slow and can take you a while to release the cash. And this, of course, can also apply to other assets in terms of your investments. But generally speaking, if you focus on constructing that pension portfolios, that investment portfolio, with tradable investments that have high liquidity, you should be able to mitigate that risk. And we'll come on to that in a little bit more detail later on. The second risk listed here is credit risk. So you get credit risk as well with investments, particularly with bonds. There is a risk that a person you lent money to won't be able to pay you back. And you also get that sort of risk with a buy-to-let property. If you've let it out to someone, there's a risk that they don't make their rental payments on time or as agreed. And thirdly, there's the reinvestment risk as well, which is predominantly to do with property. This is the risk of a void period or not being able to find a new buy-to-let property. So that's something to bear in mind. The difference between that expected rental income and what you will actually receive when looking at your projections and thinking of where you want to use that excess capital that you have. And finally, volatility. Of course, it's very natural to think about listed securities and shares going up and down during times of market uncertainty. And the pandemic was a really good example of this. With property, people don't tend to think of it being volatile because, as Tom touched on at the beginning of this presentation, they tend to think of it as property trending up over time, as it has done. And because of that, people don't tend to sell at the bottom. And if you bought at the top and then experienced a period of a market property crash at a time when you needed to sell, that's obviously not a great place to be. And so now what I just want to do is look at some of the legislation in more detail, as we often get asked this question, and it can be quite a confusing and complicated area. And one of the risks, which wasn't mentioned on the previous slide, is of course that risks of changes in tax rules and legislation. There have been a host of changes over the last few years, which have made people feel a little bit unconfident about being able to invest in pensions and have made it very hard to understand what's going on. So just looking here at the changes to the pension rules. Since 2015, when the pension freedom rules were introduced, there have been some more rules introduced as to how much you can actually contribute to your pension, which we touched on earlier on. And the first one here is the reduction to the annual allowance. And this is the amount of money that you can put into a pension in any one tax year. Currently, the maximum gross contribution you can make is £40,000. And it may be lower than that if you don't have sufficient earnings. The minimum you can put in is £2,880 if you have no relevant earnings, and that will get grossed up by the government to £3,600. And on the opposite end of the spectrum, if you have higher levels of income, it may result in your £40,000 annual allowance being tapered down to a minimum of £4,000. So it's a slightly strange scenario, this one, because in the years where you may actually have that additional income so you can afford to make those larger pension contributions, it may actually be the years where your allowance is tapered down, and so you're restricted in this. And the other place where the rules have been changing is around the lifetime allowance. So the lifetime allowance was introduced in 2006 on A-Day, and it started increasing and actually got as high as 1.8 million at one point. And you may have been able to get that fixed protection in place or individual protection in place to fix it at those levels. But it has been coming down until it got to a level of around 1 million. And then since that point, it started to increase in line with inflation, but is currently frozen at the current level of £1,073,100. And I'll talk a little bit more about this and what it means in a moment. But it is essentially the level that your pension can grow to during your lifetime without incurring a punitive tax charge. One of the positives that did come in, however, was the freedoms, being able to access your pension in a flexible way. There used to be many more restrictions about this, for example, being capped in the income you could draw down or being forced into annuity. Now, however, you have the freedom to access your pension in a much more flexible way. So you could, for example, take a lump sum to pay off a mortgage on a buy-to-let portfolio, or temporarily draw an income to cover that void period in a rental property. There's a lot more flexibility now with pensions than there has been in the past. And another key change that has come into place, I touched on the last slide, and is very attractive to pensions, is that they're outside your estate for inheritance tax purposes. And as already explained, this can be really beneficial if you were to pass away before the age of 75, and your beneficiaries are then able to draw income free of any tax at any time in the future. And if you pass away after the age of 75, it is still outside your estate for inheritance tax purposes, but your beneficiaries will pay tax on the income drawn at their marginal rates of tax. But it can still be a really useful feature. And so now I just want to go into a little more detail around the lifetime allowance tax charge, as we always get a lot of questions around this and what it means. People get really fixated on the fact that their pot has gone over the lifetime allowance and become very concerned about what level of tax they're going to pay. So the first point to note here is that your pension will only be tested against the lifetime allowance at a benefit crystallization event. So that's things like taking the tax-free cash, pension income reaching 75, things like that. And once you've used up the whole of your lifetime allowance and exceeded that, that's when you'll then incur that lifetime allowance tax charge. And a lot of people then ask about that 55% tax charge. And that 55% tax charge is what you pay if you pay the tax charge and then draw the funds out as a lump sum. If, however, you leave the funds within the pension, then that tax charge is only actually 25%. And the reason for that 25% and 55% tax charge difference is that the 55% tax charge is the equivalent of paying the 25% tax charge and then paying 40% income tax on taking the funds out. So you really need to bear that in mind and think about the fact that you don't have to pay the tax charge when you exceed the LTA. It is only at the point of a benefit crystallization event on the funds that are above your LTA that the charge is then due. And there is one final check at the age of 75, and the tax you pay may only be 25% rather than 55%. And that may be particularly relevant for those of you who are looking to leave funds in your pension to pass them on to the next generation. And that might be particularly relevant as well if you have other sources to live from, rental income and so on, and so you don't need to draw from your pension assets in your retirement. And again, this is very unique to each individual person. And so if you want to find out more about this and how it specifically applies to you, please do get in touch with advice@netwealth.com, and we can review your personal circumstances and how best to navigate the LTA. And so we've just talked about pensions, and now I want to move on to buy-to-let properties, because there have been some changes for buy-to-let properties as well, and particularly in the taxation of those. There used to actually be quite a lot of support for buying second homes, but more recently this has become a bit more tricky. There is now an additional 8% charge on capital gains tax due on second properties. So if your investment is really with the aim of getting that capital gain over time, you want to take this into account, that you'll be charged that 8%, so that 28% capital gains tax liability will be due. There's also the consideration of stamp duty. So there is an additional stamp duty of 3% for any second home that you own and buy. And so you need to bear that in mind in the transaction cost of your property purchase. It's important to remember that when thinking about where you want to invest your capital. And the final point, which is really relevant, is that over the last few years, we've been transitioning from a mortgage interest deduction to mortgage interest relief, which does impact how you move through the different tax bands. The most notable point here is that the relief has been tapered down to only 20%. So you get 20% income tax relief on your mortgage costs. And this makes the net of interest and net of tax returns on buy-to-let investing not nearly as attractive as they once perhaps were. So it's important to be mindful of these changes and how they impact your investment projection, and whether it is beneficial to look at pensions or properties in terms of your investment and funding your retirement. And to put this into more context and demonstrate this a little bit more clearly, I'm just going to pass back to Tom now, who's going to look at properties versus pensions, and in the context of your savings for your retirement.
Thank you. So lots of technical information there, and we're going to put some of this together into a comparison. So looking at somebody saving for retirement, looking at properties versus pensions, arguably the crux of this argument, or certainly the crux of this webinar today, we're looking at a comparison for somebody who is a higher rate taxpayer. So they are earning £100,000 in this example. We're looking at somebody who's considering either making a pension contribution or using the same amount of cash to use as a deposit for a buy-to-let property. So it's going to be a second property, so it's going to be liable to pay the higher rates of stamp duty. And the pension contribution is going to be £80,000 gross. So that could be using 2 years worth of annual allowances. The annual allowance in any 1 year at the moment is £40,000, but you can carry forward annual allowances from the previous tax years, assuming you haven't used those allowances previously. We're going to assume on the pension contribution, the investments grow at 5% per annum. So this person's going to invest their money in their pension in a diversified portfolio with a relatively modest amount of risk, and it's going to grow at 5% at a fixed rate. We are going to assume that instead of investing in a pension contribution, the comparison will be a £48,000 deposit, and that's calculated by looking at the net amount of cash it would take a higher rate taxpayer to make an £80,000 contribution. That's because if you were to make an £80,000 gross pension contribution, you would receive tax relief on that. So some of which you would reclaim in your tax return, and some of which would be paid into the pension automatically. But the end result is you're £48,000 short of cash by doing so. So using this £48,000 of cash, however, you're able to buy a property worth, say, £192,000 in this example, because we're assuming it's a 25% deposit that's used, and this client gets a mortgage for the remaining 75%. We're going to assume from this buy-to-let property, they get a 3% yield net of expenses. You'll notice throughout this example, and whenever considering something like this, there's always going to be lots of assumptions about what the yield's going to be, what expenses are going to be, how much the capital growth rate is going to be, and how mortgage interest rates changes. But you can see what we've used here. So it's the 3% yield. We're assuming the property grows by a further 2% per annum, and we're assuming the interest rate is 2%. So a little bit higher than the cheapest mortgage you could possibly get now, but buy-to-let mortgages do tend to be a little bit more expensive. And of course, interest rates are likely to change over the length of a retirement. So we show the comparison here of what the net outcome looks like after 1 year, 10 years, and 25 years. And we also show, just for comparative purposes, the difference between the current tax treatment of the growth of the income you receive from the property, and the deductions you can make for the interest you pay on the mortgage. And we show the old system as well. So first of all, let's look at the pension, how that pans out over this period. We can see after 1 year, the net value of this pension, if you were then to withdraw it, because you would pay tax on taking the money out of the pension, if a higher rate taxpayer at 40%, you would be left with £58,800 after 1 year, assuming 5% growth. So that's your £80,000 gross, you paying some tax on the way out. After 10 years, you'd be left with £91,000, and after 25 years, again assuming no other withdrawals over this period, you'd be left with £189,000. Now we look at outside of the pension, the two scenarios with the property. So part of this is stamp duty, of course. You'll pay stamp duty on this investment. So we've assumed there that this is rolled up within the property, within the mortgage. But the net outcome here after just 1 year is £43,000 under the previous system, where you could deduct a lot more of the interest against your property income. Under the new system, it would be 41,933. Over 10 years, we can see £82,722 with the old system, but more relevant now, the grey bar there, 70,780. And you can see at the end, after 25 years, a worse outcome still, particularly for the grey bar. So that's net of CGT at the higher rate as well, 28%, and factoring in the deduction that you can claim now on mortgage interest, but only at basic rate tax. So, of course, lots of assumptions go into this. If, of course, the pension growth rate was less, then it would be less advantageous to do so. But the key illustration really is that, sorry, the takeaway really, I should say, is that the tax relief that the government currently gives you when making higher tax rate pension contributions is very, very generous, and it really compounds up over time because pensions, of course, grow tax-free as well. And the relatively recent legislation changes with regards to property have been quite punitive, and particularly for higher rate taxpayers can make quite a difference. We just show also on the next slide, if another assumption changes, what that would actually mean. Because of course, pensions might not grow quite as much as they typically have done over the last 10 or 20 years, but also mortgage interest rates could increase significantly. And if you are quite leveraged, if you do have a mortgage, then that's of course going to make it even harder to keep up with other types of investments. So we use the same assumptions as previously, but this time we look at what would happen if interest rates were 5% rather than 2%. And we can see if that was the case, using the other assumptions as they were, we would see that the property would need to grow by 4.3% per annum to keep up with the pension. So in the past, that's not probably too dissimilar from what property has actually grown at, depending on what exactly the property is, whether it's a house or it's a flat, whether it's in London or whether it's somewhere else. But looking at where prices are now, it's interesting to think about how that might transpire in the future. And we just show there as well at the bottom of the orange line, if mortgage the interest rate went to 5%, but the capital growth stayed at 2%, then this portfolio, this property investment would actually lose money. So food for thought there, an interesting thing to consider. We're now going to look at a case study for investing with pensions and looking at somebody in retirement, how they might use their pension with other assets, and how that might help fund their cost of living throughout retirement. So this really highlights how drawing your funds is important, and making sure you do that in a tax efficient way can make a really big difference. So we look at somebody here who is 60, Annabelle, and she has just retired. She has a pension that's valued at £1 million, and she's crystallised the full amount into drawdown. She's targeting a net income of £2,750 per month. So the 25% tax-free sum that almost all pension holders can take, that has been invested into a general account to help support her income needs. So she now has £750,000 in a crystallised pension, £250,000 invested in a general account. Each year she's going to transfer £20,000 from her general account to her ISA, very sensible tax planning. And she's going to invest in a globally diversified portfolio. So it's going to be listed assets, it's going to be equities at around 60%, globally diversified across developed markets and emerging markets, 40% in bonds and cash, those more defensive assets there to minimize volatility. And her primary objective is to provide for her income, this £2,750 per month, but also she would like to pass on any remaining funds to her 3 children. So first we're going to look at what happens if she draws all of her assets from the pension first. So this £2,750 per month she needs to draw. We look at just taking it from the pension until the pension's run out, and then she's going to start taking money from the general account and the ISAs until they run out, if they do. So we have the £1 million to begin with on the left-hand side. The blue dotted line you can see towards the middle is the average outcome, and these lighter blue fans you can see either side, they show what can happen in stronger and weaker scenarios. If you're wondering, the red bold line that ends around October 2043, that's what would happen if you didn't invest. So you can see the difference between the blue dotted line and the red line is really the growth on investing in the average scenario. So we can see here, in this scenario, by taking money from the pension first, she ends up with £350,000 remaining at age 95 after 35 years, and this money is all within the ISA. So the good news here is she's met her objective. She's been able to afford her cost of living in retirement, and she has funds to pass on, which is good news. Not so positive news is the money within the ISA isn't outside of her estate, because within the pension it would be outside of the estate. Within the ISA, it does become liable to inheritance tax. So that's a slight drawback there. One thing to note here is at age 75, because she's drawn from her pension, there isn't much of a lifetime allowance tax charge, if any. So in some of these stronger scenarios where she's had really strong growth, at the upper end of this projection, she might have paid a little bit of lifetime allowance tax charge, but because she is taking money out of the pension, that is minimized. And now we look at a scenario where she draws from a combination of pensions and general accounts simultaneously, and ISAs when available. So she's drawing £2,083 a month, or £25,000 a year from the pension, with the remainder of her target drawn from the general account until that's exhausted, and then she starts to take money from the ISA. So the benefit of doing this is, by taking money out of the pension early on and later on, but not taking too much in one go, you actually minimize the amount of higher rate tax you pay. Because if you just take money from the pension early on, that could push you into higher rate tax bands, and then later in life, you're not going to be using your tax band at all, because you're going to be just drawing down capital. So by taking it out in a blended way, you actually lower your average tax rate over the course of your retirement, or you certainly can do in some scenarios like this one. So you might notice towards age 75, towards the middle of this projection, there's actually a bit of a stagger in the course of returns, and that's actually where she pays the lifetime allowance tax charge, or more so than she did previously, because in the first example, she was taking lots of money out of the pension, which meant there wasn't any growth to be tested against, so there was less. Whereas here she's taking less out of the pension, so more of it remains within to grow, and it does mean a lifetime allowance tax charge in many of these scenarios. But it actually means at the end, also because she's taking less money out of the pension, there's £461,000, so more than the £350,000 remaining in the first scenario. So that's good, first of all, that the gross sum's larger, but also the money that does remain is within the pension. And that's also great because money within the pension is outside of her estate for inheritance tax purposes. So not only has she had a lower blended tax rate that pushes that gross number up, but it also means that when it's passed on, inheritance tax will not be due, which is great for her beneficiaries. Her beneficiaries in this case would pay tax at their marginal income tax rates on taking some of that fund out. But of course, a big benefit is they have the flexibility to only do so when they want to. So they may wish to take money out of the pension, but when they're a low rate taxpayer, a non-taxpayer or a base rate taxpayer themselves. So a good outcome here just by being more efficient with your drawdown strategy. And then lastly, we just show an example here of her deciding to realize some equity from the portfolio from her primary residence, I should say, after 10 years. So it's the same starting assumption, £1 million to begin with, but we see after 10 years a step upwards where £250,000 comes into her wider asset base. Apart from that, the assumptions are the same, and this really shows how that can enhance the scenario quite significantly, and far more cash is available at the end. If she wanted to be really efficient, when she realized that equity, she could have used a projection like this to realize that actually she isn't very likely to need this money to fund her retirement. So she might have decided at this point to gift this sum to her children. Some things to think about when doing so. She'd need to be comfortable, of course, giving up those assets. But rather than take so much, 1.4 million to the end of this projection, she might have decided, actually, if I don't need this now, I can pass it on. These projection tools are something that we work with a lot with clients at Netwealth. I'm just going to talk a little bit about our approach in general here and how we blend together expert advisors with technology to deliver better net returns to clients. So you can see on this chart here some of the things we think about. So we have expert advisors both on the investment team when it comes to designing the portfolios that we would invest in the pension specifically, but also advisors on hand to talk through clients' financial planning. So looking at tax efficiency, some of the things we just looked at there, looking at risk capacity, what's an appropriate level of risk, what's an appropriate asset allocation, what are you investing for? The investment team specifically think about the underlying investments, what's an appropriate asset allocation, and what sort of cyclical positioning do we want to take, which Louise is going to come on to. And then lastly, we use our technology to really help enhance the offering. So one of the key things that allows us to do, apart from using tax allowances, which is really, really useful, it's to lower costs. So we're looking at those projections. If Annabelle, in the case study, was to pay, say, 1% more in fees than she could otherwise pay, then that's really going to compound up, not to her benefit and to the advisors or the investment managers. So by keeping costs down, you can really help extend the life of the assets or extend how much is passed on to your beneficiaries ultimately. I'm just going to pass over now to Louisa, who's going to talk in a little bit more detail about our portfolios.
Great, thanks, Tom. I thought it would be good just to look at now thinking about investing. When you get to this point, it's hopefully at a point where you have considered already your financial plan and have a good understanding of the amount that you want to allocate to pot 2, so your investment pot or the pension in this scenario. And once you're at that stage, the next step is to think about investment management. And this comes down to a couple of different things. So firstly, it's the investment approach. And so here at Netwealth, we believe in an active asset allocation and passive implementation. So we're doing active asset allocation. We're making decisions about the strategic mix of assets. That's the strategic allocation that you'll see on the left there. And then the activity is reappraised every 6 months to see if something fundamentally has changed. And so, for example, when we think about returns for fixed income, do we think that they can provide the same level of risk return going forward as they did before? And we'll check things like that and make adjustments if we need to. Similarly, we're active in the instrument selection. So instead of just picking one ETF provider and sticking with it, our portfolio management team look carefully at the different options. And there are new ETFs that are becoming available all the time. So the market's really growing in this area. And so we need to look at the costs embedded in them. Not all ETFs are equal, and they might all be relatively low cost, but there are some that are much more low cost than others. So we need to do our due diligence in that area. And we're checking as well to make sure that they're liquid and easy to trade as well. And whilst it's predominantly passive indices that we focus on, we make very active decisions about the exact ones we want to invest in and the exposures they're giving us. And another area in which we do this and in which we're active is our cyclical positioning. So these are generally risk mitigation actions. That's trying to look at what's embedded in the strategic asset allocation, which is the main thing that drives the characteristics of the portfolios, and making adjustments over time in order to deal with policy or macroeconomic changes or anything that we're seeing coming through in the fundamental data. So these adjustments are really designed to just help smooth the path of portfolio returns over time. As Tom already mentioned earlier, we have a team of experienced experts that are actively making these decisions to adjust within your risk level on behalf of you, just to give you those better outcomes over time. And that's really the methodology that you want to be applying to your pension portfolio, whether it's managed here at Netwealth by yourself or with another wealth manager. And so just to provide a bit more colour on this in the context of the Netwealth portfolios, I thought it would just be useful to look at our range of these across a risk-return spectrum. And that's really what this chart here is trying to illustrate. So what you can see here is that we have 7 different risk levels. And you can see that our risk level 1 on the left-hand side of the chart is our lowest risk level portfolio. And it's slightly more high risk than a cash deposit. And then we go up to risk level 7 portfolio, which is really trying to generate equity-like returns, but with a slightly lower level of risk. And that, again, is the role of our investment management team to think about populating these portfolios in the most efficient way to harvest those market returns and thinking about the appropriate level of risk for them. And in turn, enabling clients to then think about which risk level is most appropriate for them and their specific goals. And so when looking at your pension pot as an investment asset and the level of risk you're willing, able and need to take on will vary depending on your specific circumstances. And so it may actually be appropriate to be invested across a blend of these risk levels. And this is something that our advice team would be happy to discuss with you. So please do contact us at advice@Netwealth if this is a conversation you'd like to have. And just quickly now looking at the risk return characteristics and how these play out in the portfolio construction and the different asset allocations and currency exposures between each of the risk levels. So what you can see here is risk level 1 to 7 in these pie charts at the top. And so, as we've said, risk level 1 is predominantly cash and money markets and also has very short-dated corporate bonds. So it's very low risk. And at the other end of the spectrum is risk level 7. So that's on the right-hand side. And all of those green areas, they really represent the equity market. So that's globally diversified between the UK, US, Europe, Japan, and emerging markets. And there's also some emerging market bonds in there as well. So a risky bond allocation over time. And below that, what we can see is we have some foreign currency exposure as well. And this will vary within the portfolios. And we actively manage this for each portfolios. So sometimes we hedge and we choose not to hedge, depending on the exposures that we want. And we're keen on adding, for example, the Japanese yen and the US dollar exposures to the portfolios because they tend to be quite protective at times of market stress, which is helpful in harvesting and smoothing those parts of the portfolio returns over time. And so this is just helping you to really think about the right mixture of assets and the level of risk that you want to be selecting and choosing within your pension pot. And we will fundamentally keep these all quite similar. So it's a mixture of the blue fixed income assets versus the green equity assets, and they'll stay relatively true across the risk levels through time. But we'll make adjustments at the sub-asset class level depending on other circumstances and environments. And these decisions and these cyclical adjustments are all done with the aim of generating the best possible outcome for clients given the risk level. And what can also help with these outcomes and with generating these better net returns is looking as well as the level of fees you pay. And so this is an element in your pension and your investment assets that you can control by doing your due diligence around wealth managers or platforms that you use and ensuring that you're being as efficient as possible from a fee perspective. And to briefly put this in the context of our own fees, at Netwealth, we have 3 different fee rates, which you can see on this table here. And so the more you invest with us, the lower the fee rate will be. But this doesn't just have to be the amount you personally invest with us. We also operate something called the Netwealth Network, where you can join up with other people, maybe other family members or friends or colleagues, and your accounts will all remain separate and private. But for fee purposes, we'll look at the total amount invested across the whole network. So if you have the possibility of benefiting from that lower 0.5% fee rate or 0.35% fee rate if you go above 500,000. And you can see here a list of what's included in that fee. So it includes VAT, trading commissions, custody, tax reporting, and of course, the investment management service and financial guidance as well. And there are those other costs of investing which are listed here. And these are our conservative estimates of those costs. So you've got the underlying cost of investing and the annual cost of trading. So that's the bid-offer spread. And if you choose to open an account with us, when you go through the account opening process, you'll see a much more detailed breakdown of these fee estimates that will be applied to your investments, and specifically in the context of this session, your pension portfolio as well. And just to really highlight the impact of this over time and the impact it can have on your investment portfolio, this chart here looks at 2 portfolios worth 500,000 invested over a 20-year period. So if they both were to receive an assumed 4% gross return, and the only thing that were to differ were a 0.65% fee rate and a 1.65% fee rate, what you can see here is the effect of the different fee rates compounded over time, and it's really quite significant. So that's something you really want to bear in mind when looking at investing in a pension portfolio. And so now, just before we draw this session to a close, I'm going to pass back to Tom to take a quick look at our performance figures.
Great. So here I'm just showing our performance over the last 5 years since we've been live to the public. We are short of time, so I'm going to breeze over this quite quickly. You can see here the 7 different portfolios we offer ranked by risk. And as you can see, the more adventurous portfolios have performed better, risk level 7 returning just under 70% over this period. The more cautious portfolios performing less well, but still all positive. Here, importantly, I show our performance relative to our peers in the industry as measured by the ARC indices. ARC are an independent consultancy that gather real-life data for different portfolios ranked by risk. So in the middle, for example, you can see risk level 4, our balanced portfolios returned 43.2%. The average balanced portfolio in industry has returned 35.4%. So we've outperformed largely due to our lower fees, but partly due to some of our cyclical positioning. And then lastly, we show here our discrete annual performance, and at the end here, the annualized performance since inception. So on that balanced portfolio, you can see it's returned 7.1% after fees to the end of August. I know there was a question on that, how much have different portfolios performed by, and you can see here, yeah, 7.1% annualized for a level 4 so far. The balanced portfolio in the industry on average has returned 5.9%. So I'm going to pass back over now to the team, who are going to take some questions, I believe.
Hi, yes, thank you very much, Tom and Louisa. That's great. We've had a load of questions, which we're a little bit short of time to address them all, but we'll take as many as we can right now. And then for anyone else whose questions go unanswered, the team are very happy at Netwealth to take those questions offline, but I'll talk about that after this Q&A session now. So very quickly, first question, if I were to sell a buy-to-let property to realise cash to fund my retirement, what are the tax implications, particularly capital gains? Not sure which of you would like to take that.
Yeah, sure. Sorry, you can take that one, Louisa.
No, you go ahead, Tom.
Okay, so funding some retirement spending with a buy-to-let property. So there are lots of things to consider there. So, of course, CGT is one of them. So selling this property means that if there is a gain on it, which there probably is likely to be if it's been held for some time, and particularly if it's been bought somewhere before the last year or so, there's going to be CGT to pay on that. So that's going to be either 18% or 28%, depending on whether you're a basic or high rate taxpayer. And it's just going to be charged, of course, on the gain. So the difference between the current value and the sale price, the purchase price. So that's one thing to bear in mind, of course, but ultimately this CGT is going to need to be paid one way or another at some point. So you might make a decision to pay it now rather than pay in the future when it might have grown. And the other really important things to think about are where you're going to deploy this capital, because if you just need the cash to live on, then that's quite a straightforward one. You'll just spend that cash over time. But if you're going to reinvest this, you might want to think about where you can invest. So pension contributions are a good idea generally if you have allowance available. So if you haven't already drawn upon pensions, or if you're still working especially, it can be really, really tax efficient to recycle some of the proceeds into a pension contribution. Using ISA allowances is a great idea otherwise. But it can be a very sensible thing to do. It's just, again, making sure you're aware of the CGT and then thinking about where you deploy that capital in the most tax efficient way.
Thanks, Tom. Okay, I think we've got time for one more. So it is, if you pass your pension pot on to your beneficiaries, is it subject to taxation levels related to your lifetime allowance?
Yeah, that's a very good question. So obviously the pension falls outside of your estate for IHT purposes, and you can name your nominated beneficiaries. In terms of the lifetime allowance, as we mentioned earlier, that is only tested against at certain benefit crystallization events. So the last one of which is at the age of 75. So if you were to reach the age of 75, your pension would then be tested against the lifetime allowance, and any excess would be subject to the lifetime allowance tax charge. If after that point you were to pass away and pass on your pension to the beneficiaries, there wouldn't be a further test against the lifetime allowance. So it would be irrelevant as to whether or how much the pension grew after that point. And if you were to pass away before the age of 75, your pension would be tested against the lifetime allowance at that point, and any excess would suffer or incur the lifetime allowance tax charge. And then again, it wouldn't be tested against the lifetime allowance after that point and would be able to pass on to your beneficiary.
That's great. Thanks very much, Louisa. We're out of time, unfortunately, but it's been a really interesting presentation and so much engagement from the audience. So just to say to audience attendees with those questions, you are welcome to send those through to advice@netwealth.com, and Louisa and Tom or their colleagues will be able to come back to you on those. So yeah, sorry we don't have more time for that, but we hope it's been useful. And just remains for me to say thanks very much to Tom and Louisa and to everyone who's attended today. Goodbye.